This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high-yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASX-listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing. I'm proud to say that this Rask podcast episode is brought to you by PIMCO, one of the world's leading fixed income investment managers. With more than 50 years of experience in navigating complex global markets, trillions of dollars under management, and a global team of experts, PIMCO is a name trusted by investors worldwide. Discover how PIMCO can help you build a more resilient portfolio at pimco.com/au.
Hello there, and welcome back to the Australian Retirement Podcast, your source of spooky financial goodness. Every Thursday, I'm here with Drew Meredith. Hello, mate.
I'm a bit nervous for this one. Yeah, happy Halloween. I'm a bit scared, but get a bit nervous for this one. We are in new digs, though. They look fantastic, don't they?
Yeah, this is fantastic.
Like a lot more arm room, a lot more leg room.
Yeah. The Rask team have upgraded their pad, and it is
lots
impressive.
of space.
Yeah, it's not ostentatious, but it's
not yet.
It
anyway.
expands, isn't it? It's beautiful. Now we've got lots of cool stuff to get through, but we thought that given that this is going to coincide with Halloween, plus or minus a couple of days, we thought it might be a good opportunity to talk about some finance horror stories that we have seen in our years in financial advice.
We see our fair share. Let's be completely
we've got
honest.
Many of them. So
we don't create any. Let's hope not anyway. But I think we've seen more than our fair share in our 20 years in the industry. You've been
we're pretty old.
I mean, your dad was a financial planner too. That probably gives you 40 years in the industry,
Yeah.
growing up with that every night, talking about reasonable benefits limits and all those sort of things over the dinner table, I'm sure.
Yeah, geez, budget night was a treat.
Anyone that remembers those, reach out and send us some questions.
TRBLs.
Some curly ones, yeah.
Let's jump in. The first thing we're going to do here is have a quick boomer briefing, as we always do. And if we're talking about scary things that are happening, and we can talk about the markets right now, because there is a really significant event that's very recently taken place, which is that the US Fed has started cutting interest rates.
And the RBA too. This has got to be the scariest thing for retirees that can happen. Like term deposit rates are lower, cash rates are lower. Share markets are going higher on the other side, significantly bananas on the other side. But this is, and there's a chart which I'll find and put in the show notes to this as well, which obviously came from an equity fund manager or a credit manager, I believe at the time, that was showing that the volatility in interest rates, so for term deposits, is actually significant and even higher than the volatility in share markets.
Yeah. This hurt my head a little bit.
This is borderline chart crime.
Explain yourself. In what
talk
context
about
do you mean?
Crimes all the time. Well, if you think about it, so at the moment, the cash rate's 3.6. It was 4.35% less than 12 months ago. And if I do very simple maths on 4.35, you're talking about 16. It's fallen by 16 or 17%. If that was a share market that had fallen by 16 to 7%, the return that you're getting, you would be freaking out. That's a really big correction. And even a 25%, 25 basis point cut at the moment is, still 1/20th, 1/15th.
Mm-hmm.
It's very significant change on what can be a large portion of people's income. So while you don't see volatility on a day-to-day basis, over long periods of time, if you're rolling short-term deposits, or like a lot of people are rolling a 12-month term deposit, your interest can be cut by 25%, 20% at the next rollover date, how quickly markets move. But they also increase.
Fascinating. That is a really interesting perspective. So
did
if we go down
I
to
save the chart crime?
Yeah, you did a good job. Yeah. So if we go down to a time when it was 0.1%, for example, not all that long ago, that first 25 BIP increase.
Yeah. It's 300% inflation. Like if you annualize that, there's 300%. What's annualized?
It's such a big number.
What is it? Like 3,600. I don't know. Something crazy.
I hadn't considered this, but this is a very important thing for retirees, right? Like not just the rate cutting side, as you pointed out. A lot of retirees are naturally going to have more focus on fixed income type products, and they're inherently linked to typically the cash rate in one way or another. And we're now starting to see, with both the Fed and also the RBA cutting rates, the other thing that stands out to me here, which I welcome your comments here, but it does give some concern for me, is that equity markets continue to move north. They continue to grow. And we are now at a level where, if we think about just let's use simple metrics like price to earnings multiples, which you shouldn't use all of the time, but let's just take that as right now, that would indicate that a lot of equity markets are, if anything, they're overvalued. Now, that can have a real
traditional
impact.
metrics, as people would say.
Yeah, that's right.
If you're just listening to this, quote, air quote marks.
Air quote marks, yeah. Notwithstanding those air quote marks have held us pretty well through through the duration of investing so far. And it's very hard to argue that they would divert from that over the long term. But regardless of all of that, we put ourselves in a position potentially where we are getting the best of it right now with equity markets. Hopefully that equity sleeve of your portfolios is growing really rapidly and you're able to either retire earlier or do more things that you want to do or reduce your hours, or alternatively just have a better time in retirement, right? Yeah. But also that we do know that the higher that equity markets go, particularly if they go too far north or too far south, if they're going down, the further they go, the more susceptible they are to wobble, right? The small events, which would typically just create a little bit of a rattle in equity markets, if equity markets are significantly overpriced and then we see that same event, it can have a really substantial impact on your overall returns.
And it's interesting because at the moment, a lot of people that are heading towards retirement weren't necessarily investing during the GFC. So there's this tendency to expect, and I think we talk about it all the time, that any crash that comes turns around pretty quickly. You go to the pandemic, it took, within like 3 months, the entire market, I think the market was hitting highs again. And then more recently, whether it was a tariff, Liberation Day, each event, it's got shorter and shorter and shorter. I know Owen was on there. Was on, I think, YouTube and said, I'm putting 100 grand in the market today. And the market was up 8% before the end of the day. But basically these crises that could be like changing the face of, the global economy are just being turned around in, 8-10% gains in no more than 24 hours. So where the message there is that at some point, the recovery may not happen as quickly as people have become used to. And this is going closer to Halloween, but we released a video talking about how to protect your portfolio. So on the Wattle YouTube page, and within, I think there was something like 15,000 views within the first 2 days of it being there. So it's something that's clearly very topical and in the front of people's minds, because we know if you have a correction immediately as you're starting your retirement journey, so you've got a lot of money in growth assets and you still have to draw the same amount of money, but your capital is reduced significantly, that's what we call sequencing risk and can have a big impact if not accounted for or if you're not aware of it over the extension of your retirement as well. But I think people have been able to get away with being lazy in the last few years. Yeah. Investment wise, not anything else.
I'm with you. And I've thought about this myself, which is the idea that let's look at Liberation Day, as you said, very strong V recovery, and that for investors are plagued with recency bias. That's human beings. Yeah. We go back to the previous collapse, as you pointed out, COVID, the same V recovery,
very short.
If we go back a little while earlier, let's go to the GFC, for example. In Australia, from peak was October 30th, 2007. And it took 6 years, including dividends, to get us back to the same level.
It took even longer excluding dividends.
Excluding dividends, it was 9. I'll just clarify. It was either 9 or 11. It was a bloody long time to get back to 6,800 points, which was the previous high.
And the Japanese share market took 30 years to get there.
And the point here, again, is that yes, buy the dip and all of those really supporting concepts. But in my mind's eye, when it comes to retiree portfolios, we are communicating to our members that this is a time to just be careful. When the people that come to us and say, hey, 60 years old, up too early, and I've just inherited a big chunk of money, what should I do with it? By all means, let's invest it. Let's do that slowly. Let's not just jam that in today.
Someone sent me a algorithmic AI crypto trading fund. No, not against any of those things, but it feels toppy. Let's just say that. No names, no requirement for any names. But I mean, if I'm a retiree, I'm getting what's keeping me awake is the cash rate. And while the Federal Reserve in the US and the RBA aren't necessarily close, like interrelated, the Federal Reserve is reacting to falling inflation and a weakening economy to support the economy.
They're both reacting to the same things.
Yeah, exactly. And Australia's holding up a little bit better, perceptively, potentially. I'm trying to dial in that back. It feels like our economy's all right. So we haven't cut as aggressively, but it's still being priced into the term deposits to the investments you got available. So, 12 months ago, you could just have money sitting in cash. You're getting 4.35%. You're getting over 5% for a high yield cash account. Like, you didn't need to go into equities if you were a self-funded retiree and we were generating enough. And now you kind of have to have a foot in both camps, but you have to start worrying about where does the cash rate eventually sit and what impact does a 25% in the income I'm getting from my low risk portion have on my retirement outcomes.
Yeah, it is meaningful, isn't it? Yeah.
And at the moment, they're predicting, this was from the Financial Review at the time of recording, so in October, they're only predicting a cut to 3.35% by June 2026. This is the average of economists. I don't know why. Maybe don't tell them that air quote mark.
I think the fingers
the average of economists is for it to be, so median is 3.23s, but I mean, they can't cut by 0.35. So basically one cut before June 2026. But then in some of these cases, you've got people going as low as 2.85%. So that's another 75 basis points before June. So that's what, three rate cuts before then. And the vast majority, at least around that 3.1%. So 2 rate cuts within the next 6 months, which would further reduce the income you're getting.
Why can't they cut by 0.35? They can do whatever they want, mate.
If it was me, I'd be like, 3.6, I don't like the sound of it. Let's just cut it 0.1 and we'll get to 3.5. And now we can, like, I can't measure in just 0.25s. It's easy.
This is like the supermarket idea that everything is like $1.99. Like it's 3.59 is the
same.
rate. Yeah.
I mean, it doesn't. That's another. Maybe we could, a grumble for that one is why does the RBA? Why does central banks cutting 25 basis points? I'm sure someone's going to answer this, and there's a good reason for it. But
would be keen to see it. That
Prove
was the
me
right
wrong.
increment at
Prove
the time.
me wrong.
It is interesting though that increment. Let's just finally close off on this point. But the idea that increment might have been more appropriate in previous eras where interest rates were higher,
7%.
So if your long-term interest rate, for example, is in your 7s or 8s, for example, then 0.25%, 8%. Cool. We've still got plenty. That's 1/32nd, like 1/30th of the. So you've got lots of room. When interest rates are 2.5%. 25% or 0.25% is 10, cut. So it's material. Let's get down to some horror stories. We collated a few of these beforehand, and I will. I'm happy to open the account with the first one here.
Out.
This
is the worst things we've seen.
Yeah,
some of the worst.
Some of, yeah. Let's start firstly with an event that happened to me. I was working at a firm during the GFC, not as an advisor, but doing application forms and making teas for people and that kind of stuff. And I was sitting down. There was an advisor that we'd prepared this annual review. It's 2009 and it's a bloodbath. Like the portfolios are shot everywhere, and we've sat down with this couple who are pre-retirees right in that spot, and we have opened up their portfolio on the big screen to talk about here's how things are going economically, yada yada yada.
You got a big screen in 07.
Yeah, it was
nice.
a real treat. Yeah, this was 09, but yeah, it's still good.
No camper.
So we're rolling through, and the advisor is presenting and gets to. His portfolio.
These are the worst meetings too. Like I was doing them at the same time, and this is like you're showing 30, 40, some companies gone to 0. Like it was incredibly challenging period.
Well, this one was worse than that. So it was open up on the screen. Hang on, let me pull open your portfolio. Here it is. Okay, it's done. I think the platform was IWF, and there's your account, and the balance right now is $211,000. And they go white. Yeah, just absolutely white. Panic, fear. And the advisor, I don't think quite noticed and sort of kept going on and talking about the economy and so on. And we sort of checked
and the income.
in with them,
we always went back to the income. You're still getting dividends.
Like, how are you doing here? And are you okay? And their concern was that only 6 months ago, their portfolio, it was already falling, but it was worth $800,000. And it was now worth 211. And the advisor had decided to, sort of double down on this and say, yes, I know it is a volatile time. Talk about Fannie Mae, Freddie Mac, the banks, like Lehman Brothers, etc. And I'm sitting there quietly in my own mind thinking, there's just no way the portfolio could have fallen 75% over that time.
Unless you're in leverage.
Yeah, which which they weren't, but I'm sort of too young to say, look, can you give me the controls? So I just have to sit there and sort of go through this. And after a little while, and this conversation was getting more and more uncomfortable by the second. And I said, hey, would you mind just excusing me for one moment? And I slipped out and then went back, opened up and realized that that's not their portfolio. Their portfolio is worth about $580,000 or something from $750. It is down, still awful, but not to that magnitude. So I went back into the room and sort of managed to get controls for a second and scroll up and realized that the advisor had opened up the wrong client with a different surname. Oh, sorry, the same surname, but the wrong John Smith the wrong client. And then rolled.
It wasn't
through.
John Smith, by the way, for privacy reasons.
Anyway, we rolled through that. We managed to at least clarify. Hang on a moment. That is the wrong portfolio, and there's no way you can avoid that awkwardness. And so, surprise, surprise, they finished up as a client, rightfully so. It's like if you were sitting in a review meeting and you're saying it could have fallen by 70%, you had no context as to whether or not that was true. It's clear
work out, and the junior worked out it was right. The guy who brought you the tea.
Yeah. And the tea would have been good, by the way. I've been a long time tea drinker, but
put something else in there.
But that was that was a rough meeting. And so mental note, if you ever go and sit down with a financial planner, make sure it's your portfolio.
Never trust your information. And if you're the advisor, never trust the information.
Over to you, mate. Thanks for watching this episode of the podcast. A common question that we get at Rask is, how do I need to be prepared if I want to see a financial advisor? There's a few things that stand out that may really help you if you want to get the best from an advisory relationship. The first is to come prepared. It's really valuable if you can arrive at that meeting with a good sense as to what you want to achieve from an advisory relationship. Now, there's lots of different financial advisors out there that operate very differently. And if you don't have a good sense as to what you want to achieve, it can be kind of easy to get pulled into their advice philosophy and their approach. It can be hard to define what is the best advice relationship for me. So whether it's you and your partner having a good conversation to say, what do we actually want to get out of this? That will really, really help you to know that you're in the right place when you sit down with your advisor. The second one is to be open-minded. You may very well work out that there is one or two specific things that we're looking to address with our financial life. But a really good financial advisor is going to be thorough. They're not just going to look at those things. They're going to be as exhaustive as they can be about your entire financial life and make sure that everything is lined up and set up the way that it should be. So when you go into that process, please be open-minded that the highest value that you might get is not necessarily solving those one or two acute things that you wanted. The last thing is to be curious. If you are watching this podcast, it's probably because you are watching or listening. It's probably because you want to learn more about your finances. You want to level up when it comes to your education. And if you're going to meet with a financial advisor, it may be your first opportunity to transition that general knowledge that you've developed about your finances into your own situation and how it applies to you. So be curious. It makes sense for you to try to understand as well as possible, how do all these things work for me? Because at the end of the day, it's your financial journey and it's your money, and all of the advice should be helping to serve your unique situation. Now, if you want to learn more about how to get the most from your advisory relationship, you can either scan here, and that will take you to a guide that gives you a heap more information. Alternatively, if you scroll down below, there is a link to a Northeast Wealth page that we put together not too long ago, and that similarly outlines the key things that you should be doing in order to get the very most from the relationship. Thanks again for watching this episode of the podcast. I'm James O'Reilly from Northeast Wealth. We hope you enjoy it.
Mine, these along a similar line, and these are kind of scary, and these freak me out a little bit too. So there's one that we've had, and this is a lot of this comes from people falling outside the area of specialty. That makes sense. So accountants getting involved in investments and superannuation. So we had a case where someone transferred a property. So technically a commercial property. Again, I'm doing air quotes quite often because obviously you can't deal with residential property with yourself. So it has to be a commercial business real property. It has to be leased. Not just leased, but it has to be for business purposes. But a property was transferred into an SMSF, but I don't think they were fully explained on what they had to do during the period once that property became part of the SMSF. And a couple of issues arose from it, which is one person viewed the property as being their own property, when they transfer it in. But obviously, once you put it into an SMSF, it's not a segregated fund. So now both partners own part of the same property. And then it's going through a conversation about how do you get the property out is what triggered this. Turns out the title wasn't ever registered appropriately, properly for the entire fund.
Oh no!
Yes.
Oh dear.
And rent wasn't necessarily being accounted for properly during the process. There was no leverage or anything, so it's obviously a bit more simple than that. But now the member balances are very different. So what someone thought was their property is now no longer fully their property.
Oh, because there's a much higher proportion.
So now if you want to get the property out, you have to basically change the ownership for it to have an exemption from stamp duty. The ownership has to be in a similar share as to what the members' balances are within the SMSF. This is like your face is my face when I learned about this. It's not executed by us, identified by us, and finding all the appropriate ways to deal with this now. But if anyone has a question about why their SMSF fees and their audit fees are going up, this isn't that common, I hope. But this is one of the reasons why. Like auditors on direct assets and SMSS more generally are under a lot of pressure to be more diligent, I guess, and be more independent. But that was probably the worst thing I've seen in my career.
Yeah. Did you solve it?
Yes, it'll be solved, and not too much of a issue to the client.
Yeah.
Like most of these things, if you're upfront and deal with them appropriately, can be solved.
Yeah.
And in most cases, just highlighting it, admitting to it, and dealing with how to fix it after that point. Yeah.
Wow. Okay. Wow. Okay. All right. Well, you were talking about accountants before,
and it wasn't mine.
We had an issue not too long ago, like within the last 3 or 4 years, where we had someone come to us who is a very high income earner and earns a lot of cash.
Yeah.
And
you mean like cash?
Cash.
Yeah,
that's right.
Yep.
And that became, it was evident pretty early on, but then explicitly they said, well, that's because there's a huge amount of cash. Now, that's a horror story for me as an advisor, and also for the prospect, because if that information is given to us, it is my legal obligation to notify Austrac and to report that. And so this is an important distinction that falls between financial advisors and accountants. For most accountants, they have, because they're not
covered by anti-money laundering.
That's right, and counter-terrorism rules.
Yeah,
and then also they're not. I think the term is they're not a provider, like a registered provider. Of products, and as a result, in a lot of cases, an accountant can see that and choose not to report that, as long as it's not absolutely blatant.
Yeah.
But in my case, then I have to report that information.
Yeah.
So of course, not only am I declining the work because naturally you don't want to get caught up in that, but then also the person that's come to me is presumably getting investigated. So
by Austrac. Yeah.
By Austrac. So firstly, don't defraud the government by earning a truckload of cash. But secondly, if you go to a financial advisor and say, I probably shouldn't be telling you this, but I make a lot of cash, you should understand that it is a financial advisor's legal responsibility to now
report that. Yeah, exactly. I mean, it's a good point, and it's I don't think it's as prolific as it used to be, but it's still a big part of the economy as well.
Yeah.
My one's going to be, so insert stock here, refusing to sell Woolworths, CSL, it could be anything, BHP, refusing to sell a holding that is more than 50% of your net worth. It came up recently because obviously there's a number of stock. I mean, Woolworths, one of them, CSL's another one, where they've fallen 30% in a very short period of time. And it's probably less scary than the first one I talked about. But there's this tendency to avoid the payment of capital gains tax or any tax, even though it's clear. And any advisor you meet, regardless, if you've got 40 to 50% in a single stock, they're going to tell you to sell it in some way or another, whether it's sell some a little bit at a time and start to reduce it. But in retirement, relying on a single investment or a single company for such a significant part of your asset, even if you've got more than enough assets,
madness.
It's still emotionally devastating when things like this happen as well. So one is, objectively, it's easy. Yeah, sell it, pay the $400,000 in capital gains tax, and they just say no, and like, fine, all right, no, so we'll dial back from there. But this one, and it's so easy from an objective perspective to say it, but getting someone, because then the tax bill doesn't come for 12 months' time, because you obviously don't lodge your tax return until the following year. And then you get this surprise tax bill that pops up, and then you get PAYG. And so I get all the concerns about it, but this is one that it's coming up less and less than it used to. I think more people are aware of it. But this is, pops up all the time, and just, take the pill, swallow the bitter pill. I think it's, I'm trying to work on my little,
just don't talk about blue pills or red pills. Just,
We're not in the Matrix. We're all right.
That's brutal. And we were talking before about recency bias, right? Yeah. People, especially if you own a stock that's performed really well for a long time, people who bought CSL at $5 and it's now worth, at a point 310. And why on earth would I let this go? This has created so much wealth for me. But especially when you've held a company for so long and you become enamored with that, I think two problems happen. The first one is you feel like it's going to continue to do wonderful things.
Sunk cost bias or endowment bias.
No, this is recency bias. Sunk cost bias is when you're losing money and then you
keep on
hold on to it. So that's where they might be now.
Shortly afterwards.
But in this scenario, the other trap I think that happens is that as you have let's say a single stock, let's call it CSL, for example, because it's had such a huge tear from such a low base years and years ago.
Or CBA, we could touch on that too.
No, do we? In that scenario, you're learning more about the company as the value of it grows, and you become more interested in it. You read more articles about it, and the byproduct of that is you develop a superiority bias where you think that I know more about this company than what is being reported, and I have faith that the current team right now, I faith that the strategic direction is where I go to some AGMs every now and then when I can, and I actually know CSL pretty well because it represents such a big part of my portfolio. Please, please, please don't fall for the trap of thinking that you are better equipped to make the decisions that are going to move the CSL share price than the fund managers that have a tremendous amount of resources, capital, intelligence, data, all of those things. So again, as the portfolio gets bigger and bigger in that one position, you may very well become an expert in that position. That doesn't mean that you are better equipped to know whether it's going to rise or fall. And I think a lot of people fall for that trap.
Yeah, I think it just overconfidence breeds into it as well. One way I've traditionally used to try and deal with this is let's sell it and make sure when we sell it, we make an estimate of what tax is going to be payable. And the same for property, same for any kind of large capital gain, put it into a term deposit. Put in with a period that matches when you're going to pay your tax. So we don't forget about these things. They don't come as surprises. You can even call the term deposit or bank account tax, something like that, anything. But it helps kind of realize and remove the shock of when that tax bill comes of the decisions you made today.
I like it. That's wise. Let's talk about an individual who presented to us quite a few years ago and had bought 50K shares.
I saw this on the notes. I'm like, this could go really well or really bad.
Yeah, this one went really badly.
Oh, there we go.
So they had bought 50K worth of shares. I can't remember the company, but it was an ASX 100 company.
Yeah.
It was a big amount of money for them to spend. They got a tip from a friend. They said, yep, I'm good to go. They went online. They think they might have used ComSec.
Yeah.
Pulled the trigger for what they thought was $50,000 of shares in the company. But they didn't buy shares. They bought call options. And of course, the difference, if you buy a share, of course, you own 100% of it, happy days. If you have a call option, then that gives you the opportunity or the right to be able to purchase that share in the future for a set price.
Yeah.
And so, of course, it's a bet. If the share price goes up in value and it exceeds whatever set price that you had, then happy days, you are going to buy it at whatever agreed price it was, and you'll make immediate profit. The problem was that this share had gone on an absolute tear. Had done really, really well. So the stock tip that this guy got was a very good one, except he needed to find a huge amount of money.
Because each option is like 100 shares or something.
Yeah, I think in this case he needed to find, would have been about $700,000 or thereabouts in order to fulfill this position. And desperately wanted to fulfill it because it is in the money.
Did he know he'd bought the...
Well, he learned as time went by. And so when he reached out to us, rather than saying, I'd like to get advice on what to do, he was looking for an investor. He was saying, here's the situation, and I need...
There's only PA.
I need $700K, and you can see that the investment is in the money. And if I can find the 700K, I'm going to make a really good profit here, which I'm happy to share. I just need someone to invest on the other side. Now, for no other reason than
that's the sound of James opening his checkbook.
Curiosity, yeah. Well, I thought to myself, if this is a scam, this is a really good scam, and I'm curious to know if it is. And so I did my own due diligence as best I could, and I spoke with CommSec, and we had third-party authorization forms and things like that. And no, this all looks very, very legit. Like, unfortunate. I don't know where it landed. I said, look, unfortunately, I'm certainly not going to open the checkbook for this one. That'd be conflicted, and neither can I recommend, and any of our members do.
Yeah.
So thanks, but no thanks. And hopefully that individual is
wealthy
off on
and
a
didn't take on a big
island
mortgage
somewhere. Yeah, but it didn't look that way. It really looked out of desperation, like you wouldn't find the money.
So if it has an O after it on CommSec, usually means it's an option, doesn't it? That's a very simple rule of thumb.
Yes, that's right.
But if you're on other trading platforms like the Saxos, all these kind of groups, options are very easy to trade, very hard. It's very easy to make similar mistakes.
Yeah,
and they're incredibly popular overseas and somewhat in Australia as well now because of that leverage. Because on average, something like every one option gives you the right to buy 100 shares in a company, which is 100 to 1 leverage.
Yeah, it's a pretty fantastic vehicle, but it protects the underside because you're not contributing too much. And then if the share price goes really high, let's just imagine that you're buying call options, then you can do tremendously well. If it goes tremendously low and you're buying put options or selling put options, then similarly you can do well. But that's not for today. We're talking horror stories, so let's get on with it.
Same. This one comes up. I just have to keep saying it over and over and over and over and over because it comes up. It inherently comes up every time there's some sort of crisis or correction. This was in 2020, so back in the beginning of the pandemic. Someone in an industry fund, so didn't know much about where their money was invested. All they saw was a unit price and an investment option. And quite common, I think there's numbers on the amount of people that switched investment options. But this was the old, I can't remember what bias you call it, but basically as your money keeps going lower, at some point, everyone, and you have to have lived through the GFC to understand this, at some point everyone goes, I need to sell to protect what I have left. Very few people don't have the emotional wherewithal to never feel that feeling, whether you react to it or not, and that's where an advisor can come in to stop you from doing it. But this client switched from growth option into fully defensive, so from 80% equities into like 10 or 20% equities at the bottom of the market in 2020. Our advice, so we were looking at husband and wife. It doesn't matter who made the decision. It was kind of a family decision. They switched one and invested the other one with us. I'd suggest, the problem here was it was there for probably 5 years. So and at every point it became harder and harder to then re-switch because the recovery, even if the recovery didn't come that quickly, which it did in something like, I think it was within 12 months, it had fully recovered. But it didn't matter. Every time the market kept going, it was harder and harder to influence or to recommend, not even recommend, we were recommending it all the time to make that switch back because you've capitalized a loss on the growth and now you're stuck in a defensive asset and then defensive assets end up doing worse when interest rates rose as well. So it was like capitulation on capitulation and you get so trapped in this, in almost in your own mindset, your own biases that you can't make the decision to switch. And that's where the more, like the decision to switch at the bottom, fair enough. You felt more emotional and you had other assets that were exposed to growth, but the inability to then course correct at some point was where the real damage was done. There's so many times.
Yeah. So there's and
it's right as they're seeking advice. This is why they have the urgent SOA kind of thing too, I think. How do you stop someone from making that decision?
Time critical advice document. Yeah. There is quite a few years ago, I was listening to a podcast that was talking about gym memberships and said that there is a scary number of people that own gym memberships and don't attend for an entire year. So subscribe, pay my $1,000, for example, like monthly or whatever, get to the end of the year and then do it again, despite the fact that I haven't been once.
Well, they go, I'm going to go this year.
That's right. Yeah. It's because if you cancel your membership, that means that the previous 12 months was a straight loss. Like I didn't go once and then it ended. So what you do to make yourself feel better about that previous year is say, that wasn't my time, but I'm going to go again. Sometimes it's even it's an upgrade. Like I'll also add some extra features to this because then I'm going to use it, for example. So people that haven't used it in a really long time actually have a really high propensity to not only renew, but upgrade using that as the vehicle to say, well, now things are going to be different.
Well, that's how the streaming groups make money, don't they? And that's why subscriptions do it as well.
So this sounds like exactly the same thing, right? If you this person has obviously sold out. That was their view at the time, and then as things have got worse and worse for them, as their bet has become worse and the market's recovered, they're in that state of mind of thinking, but if I move back to investments, I'm going to be able to quantify what I lost.
Yeah. That's always the hardest part. This is sunk cost bias.
Yeah.
Yeah.
So there is a very simple and critical rule of thumb here, which is that if you are if you're looking at reducing your level of exposure to inside your, for example, superannuation portfolio due to market-based events, and you aren't seeking the advice of a financial professional, you're a damn lunatic. Yeah. Okay. And I can't be more blunt than that. Like this is the first time on this show, like 60 episodes we've done where I've said you must see a financial advisor for this, but this is one of them, because the magnitude of a mistake here can be absolutely tremendous.
Yeah.
And what you're doing might be perfectly intelligent for your situation, but to not go and even, for example, do it exhaustively and pay the $1,000 or the multiple $1,000s to get a full comprehensive piece of advice, that is a drop in the ocean compared to the potential magnitude of making the wrong play here. So please, please, please don't do that bit yourself. It's okay to feel that way. Just get some professional help.
And I constantly get asked, what would you do if a crisis hits, by potential clients or prospective clients that we're talking to.
Is this where you recommend those leveraged altcoins?
Yeah, exactly. Algorithmic. But the answer should be simple. I should be doing nothing to very little, like a very narrow band. If I'm suggesting you'd change your portfolio completely, well, I wasn't prepared and I wasn't diversified and I wasn't being prudent with your capital. Like if a crisis hits, your portfolio, if managed appropriately by an advisor, shouldn't need to be changed all that much. If anything, you might be able to take opportunities or anything that you might be able to might free up cash to make sure you've got enough cash flow, but not making wholesale 80 to 20 growth assets splits at that kind of time.
Iterative changes, not wholesale.
Exactly.
All right, I'm going to do one more if I may, and then I'd love to throw to you. Let's talk about the importance of screenshotting your caps. One of your biggest recommendations, in fact, your number one recommendation for 2025, log into MyGov, get your account set up, and that's
it helps
pretty well, actually.
People that I don't expect to have done it come in there. I've got my MyGov. I'm like, this is fantastic.
Yeah, happy days. Thank you. Thank you for listening to the show. So in that case, one of the things you'll get to the ATO portal, and then up the top you've got manage, and you've got concessional contributions, and you've got catch up concessional contributions, and then you can look at that, and that will, through that portal, will tell you have the ability to contribute this much in additional catch up concessional contributions. I cannot stress to anyone that does that you should screenshot that from the ATO, and you should and print it or whatever, save it, just do something, because we not too long ago had a case where someone came in and we ran these numbers for them. We gave them advice. They sent through their stuff. We said, yep, all fact checked. We looked at all the years. Yes, those numbers tally. And of course, we sought to maximize not only that year's concessional contributions, but also utilizing the carry forward concessional contributions.
Yeah. And you have to contribute over your cap to do that. Yeah.
Correct. And so you contributed well over his cap to do so. And then the ATO came back with a different set of numbers in October and said, no, you now have to pay a reasonable chunk of tax because these forms non-concessional contributions. And we went back to them and said, no, just check your numbers again. And then they came back and said, no, our numbers are correct. And then in the wash up, we realized that the numbers on their portal had changed.
Yeah.
And it wasn't due to tax reconciliation from the previous year. It was actually about 3 years ago, like FY22 or one of those sorts of years, where the cap said that it was, for example, 15,000. It was actually 10, or it was actually 5 or something different.
They missed one, yeah.
That's right. And so we went back and explained, hey, why do we have this change? There's got to be a reason. And then there was a long delay, and they came back and said, yep, sorry, our bad. Never mind. Let's just all get on with it, which was lovely. But it just goes to show that, the ATO, that
not everyone's perfect.
This is being done by an automated system. And if there's any reconciliation that's done at any point, for example, if there are big contribution caps made, then in that case, that error might be spotted. So please just be prudent. Screenshot them. Don't have the huge headache that we had. It was very stressful. The member was really uncomfortable because it was very important to them that they didn't pay an extra 8K in tax. Yeah, it was horrible.
I mean, my last one is very similar to that as well, which is people who are consistently going over their contribution cap. And sometimes it starts off as being inadvertently, but then it just continues every year and every year. This tends to happen for those getting higher default contributions or on higher salaries. So it could be you're getting 17% because you're employed by a university or a hospital or something in the public sector. But what happens is if you've inadvertently gone over and then again, this was an accountant suggested additional contributions, they immediately were over their concessional contribution cap, and this is when there was the tax was higher, which put them over their non-concessional contribution cap, but they'd also done a bring forward non-concessional contribution, and it creates this whole. It's like I can't remember, like a labyrinth of complexity. It's hard to ever catch up on it. But the problem wasn't that it happened once; was that it kept happening. And even once they do a normal year of non-concessional contributions, but the excess concessional would put them over the limit, and they'd do a bring forward again because they'd nominate for that to be non-concessional. So it just became this. It's all sorted now, but like I think the key here is always having process and structure around reviewing your contributions and considering everything before you go ahead and do it. And that's why we have a look in January, but then we have a closer look in May and June to make sure you're not inadvertently go over those caps. And MyGov is probably the best thing for this in the last few years. Like 10 years ago, it was very difficult to find all. You were going through superannuation statements from multiple super funds, finding stuff. You had to find everything, as opposed to just having a simple source that's usually correct for your contribution caps.
All right, there you have it. There are some simple but clear horror stories that neither of us enjoyed going through. There are many more. We had a big long list, so at some point we might have to do a few more of these. Thank you so much for dialing in. Happy Halloween to all of you. Hopefully your financial lives are a little bit more orderly than some of the stuff that we've gone through today. But as always, really appreciate you listening into the show. If you've got any questions, please hit us up. We would love to answer them for you. Thank you, everyone. Look forward to speaking to you again soon.
Good to see you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.